I'm Stan Barnes, and I'm here with Eddie Hatch, and we're Barnes Capital Group. So the last time that we came to you was back at the end of November, going into the holiday season and the end of the year 2019. The situation was quite different then than it is today, and the circumstances that we find ourselves in. We'd like to hopefully today give you some insight on what's going on in the markets with our traditional guest, Chris Zaccarelli, and we're going to really be focused on helping you to understand the market and the moves that it's been making recently. We do not have our typical lineup of some of the other guests, but we will hopefully by the next quarter be back to normal on that front. I did want to mention on a brighter note that we have moved officially our office location to 1801 Hermitage, the Hermitage Center. That's 1801 Hermitage Boulevard at the Hermitage Center. And we are still hanging pictures and unpacking boxes, but we look forward to welcoming you when some of the restrictions that we're currently living under are lifted, hopefully in the not too distant future. And now I'd like to welcome our regular contributor, Chris Zaccarelli, who's the Chief Investment Officer of Independent Advisor Alliance, who's calling in from Davidson, North Carolina. We're going to be talking to Chris today about his insights on the current market conditions and hopefully give you some actionable items in looking to the future with your own investments and portfolios. Chris, how are you this morning?
I'm doing well, all things considered. How about yourself?
Well, all things considered, I think we're getting through it. Things still functioning up there in North Carolina.
Everything's running pretty smoothly, and hopefully it'll stay that way. I'm pretty optimistic that we've got this under control and would love to see us kind of bounce back as soon as possible.
Very good. Well, the last time we taped one of these sessions, we were in a lot different environment that we find ourselves in now. It was toward the end of the year, early December, when we taped, and catch us up on sort of some of the things that have been transpiring since we closed out 2019.
Absolutely. I mean, to your point, things were so much different just a few months ago. It's really hard to believe, but we finished 2019. The S&P was around 3230, which was up 376% during the entire bull market, which ended up running about 11 years. So, the bull market started on March 9th, 2009. Not only was it up 376% by the end of last year, when we hit our peak earlier this year, we had gone up 400%. So this bull market, which ended up lasting exactly 11 years and 3 calendar days, unfortunately came to an end, earlier this month. And so, unfortunately, due to what's happening with the coronavirus and the almost self-inflicted recession that we've created in this country in order to try to take steps to mitigate the virus, you've seen the stock market drop as much as 31% as of last Monday. So things have been moving really, really quickly. However, even now as we speak, with that big drop and a nice bounce back that we've had over the last few days, as we're recording this, we're still 275% higher than we were on March 9th, 2009. It's important to remember that even though we've fallen quickly, we're still up so much farther than we would have ever imagined back in March of 2009. And so, fortunately, I would say, despite the short-term, pullback and concern, it's definitely worth keeping things in perspective for the long term, because that's what stock investing is all about.
Yeah, I think the tendency of everybody is to sort of compare and contrast their last point of pain as it regards the stock market. And so I think, folks that vividly remember what we went through from 2007 to 2009 are thinking, oh, here we go again. It's going to be the same type of long protracted thing that we had then. What sort of contrast or differences do you see with where we were as a country, as a stock market in now versus during that period?
Well, there's a lot of contrasts, and most of them are for the better. Unfortunately, the worst contrast is, we've never had a situation where you needed to stay home for an extended period of time. You were worried potentially about your own personal safety. That's a psychological aspect that we did not have to go through the financial crisis, and that's probably the worst thing about what we're dealing with now versus back then. But fortunately, everything else about what we're dealing with now is completely different than what we were dealing with back in the 2007 to 2009 time frame. as I'm sure many people will remember, we were worried about the banking system. We were worried about the solvency of how all of markets and how all of the economy worked. We're not worried about any of those things right now. The banks, especially in the United States, are extremely healthy, well capitalized, and the economy, although we've shut it down really almost on purpose, we can start it back up again. And I don't want to imply that shutting down the economy as quickly as we have will make it easy to start it back up again. There will be some challenges. It'll be difficult. But unlike back in that time period, we just have a much stronger banking system. Frankly, the U.S. economy was much stronger heading into this current period than what we were dealing with back in 2008. But not only that, all of the tools, all of the playbooks, all of the strategy that the Federal Reserve had to devise on the fly back in 2008, they have that playbook. They have that authority. They have all of the tools that they need in order to make sure that markets can function properly during this time frame. And so fortunately, the Federal Reserve is able to do so much more now than they were able to do back then. And so that relieves a lot of uncertainty for professional investors in terms of the markets. Now, I'll be the first person to say what we're dealing with right now has nothing to do with lower interest rates. This was never a war that the Federal Reserve could win. All the Federal Reserve could do is make sure that the markets continue to function properly, both in the bond markets and stock markets. And unfortunately, proper functioning markets does not mean markets that don't go down. Markets can go down quite a bit in a properly functioning market. What really is needed is fiscal stimulus. The fact that we're shutting the economy down, withdrawing so much consumer demand from businesses, and frankly putting businesses in a situation where a lot of them are going to have to lay off workers, and we're going to find a lot more people unemployed, hopefully just on a temporary basis. But that aspect of this fiscal shutdown is different. As you remember back in 2008, of course there were a lot of layoffs. Of course the economy went to recession, but it was more of a slow moving type of process, whereas this has been a lot more, much of a quicker process. So those are probably the main contrasts between back then and right now.
As we are taping this, later today, the House of Representatives, I believe, is going to be voting on a stimulus package. And if you could just maybe comment briefly, there's been, I think, certainly a lot of supporters of this stimulus package. There have been some detractors. What's your take on it?
I think the stimulus package that the House is about to vote on is something that's very important. It's about $2 trillion that they want to put into the hands of businesses and consumers, specifically those people who are unemployed, but also those people who need the most help. Really, the way to think about this is it's not a bailout of large companies or people who took on too much debt and took too much risk. This was really an unexpected event where a virus came from overseas. In order to fight this public health crisis, businesses and consumers were forced to shut down all of their activity. I would definitely think of this as more like a hurricane or more like a flood. It's one of those things where it's really through no fault of anyone's own, whether you're a business or whether you're an individual worker, that we're in this situation from an economic point of view. To the extent that most of the package is structured in the form of loans, that to me seems like the best way to do it, because I don't think you want to just drop money on people and put the government further in debt just for the sake of getting out of this crisis. It makes a lot more sense to use the borrowing power of the federal government to extend a bridge loan to those businesses that we want to keep afloat so that when they get to the other side, they're able to rehire workers. We want to make sure those people who are getting unemployment insurance that were really forced to get it because of being told they have to stay home and are no longer able to spend. So that's really the right way to look at this. It is a counter-cyclical type of push. It's something that governments really should do when you go through downturns. But again, the important part is you're not trying to bail out someone who's made bad decisions, and you're not trying to put the federal government much more in debt in order to do it. Now, that being said, not all of this package is going to be in the form of loans. Some of it will be in the form of forgivable loans, which effectively will add to the debt of the country. And so while that's something to keep in mind over the long term, in the short run, getting the economy working again, getting GDP higher, getting tax revenue for the federal government, both from businesses and consumers, that's at a normal level as opposed to a recessionary level, is another thing that's great for the federal deficit and for the federal government. So even for those people who are worried about debt increasing in the federal government and worried about using government money in a way that some people may consider is ill-advised, I would really counter with the fact that it's in all of our best interest as taxpayers, as citizens, to get the economy up and running again. And the way that they've structured this, I think, is a good first start towards trying to solve what is somewhat of a unique challenge.
Hey, Chris, given the fluctuations in the market, how do you interpret the rally that we had on Thursday after we had such a large unemployment number?
So, markets are really interesting. Everyone always talks about them as forward-looking. And the way I look at things is that huge sell-off that you saw prior to even this week was really taking into account that the economy was going to take a huge hit. We're expecting that we're in a recession. We're expecting that many people will be laid off and that you will see, unfortunately, a big drop in economic activity. And so the market had already priced that in. Now, the jobless claims number that we saw just yesterday, Thursday, March 26th, was astronomical. I mean, it was higher than anything we've ever seen. And I think it really goes to the point that, we are dealing with a very unusual economic shock that's come very, very quickly. Again, it's largely voluntary and considered, one way to handle this public health crisis. So I think the market was going higher, not obviously on bad news. I think most of the bad news was priced in. If anything, I would view that awful number yesterday as confirmation of what the stock market had already priced in prior to that time. Now, we know from history by studying the markets, not only just over the last 50 years, but over the last 100 years, when you're in a bear market, which is what this is, once the stock market drops 20% or more from its closing high, you've considered to enter a bear market. Bear markets have rallies all the time. The hard part in a bear market is trying to pick where the bottom is going to be. It's very, very difficult to know when you're going to get to the last point of selling, and that buyers will step in and you will move higher. As I mentioned, back in the 2007 to 2009 crisis, it was March 9th, 2009, which happened to be the absolute bottom of the stock market. Prior to that time, we had sell-offs and we had rallies, and we had sell-offs and we had rallies. No one knows which rally will be the last rally that you need to go. So I think, what we're dealing with in terms of volatility is very normal. We've seen it many times before. And unfortunately, there's no way to know that if this particular situation will be exactly the same as the past. I like to say history doesn't repeat, but it rhymes. And so you can learn some lessons from history. But unfortunately, just watching what's happened in the past doesn't give you a guarantee of what will happen in the future.
Right. So that gives us a pretty good handle on where things stand and where we've come from. But maybe let's get a little bit more practical and grassroots. And obviously, we're closing in on the end of the first quarter here. People are going to be getting their 401k statements and their investment statements at the end of the month. What should they expect to see, and how should they respond?
I think when you get your first quarter statements, there's no doubt you'll see them down quite a bit, whether the stock market's down 20% or 30%, and whether the bond market is down 3% or 7%, you're going to be dealing with a statement that's quite a bit lower than what you saw on December 31st, 2019. As I mentioned, that December 31st, 2019 statement was already up 376% over the bottom from back in March 9, 2009. So keeping things in perspective, we had run so far for so long, literally almost 11 years in the stock market. And so the actual values you had in your account were very, very high. Even now, as we speak, if you look at, where we are in the stock market, having lost maybe about a third of that, you're still 275% higher than you were back on March 9, 2009. So there's 2 points I would make. One is, clearly the amount of money that your accounts have gone down is going to feel like a lot. There's no doubt about it. I feel that way, and I know everyone else I know who's going to look at their statements are going to feel that way. The important thing to know is that just because your account balance is down, it doesn't mean that you've lost money. If you want to cash out of your investments and you want to just get out of the market, you will have locked in your losses and you actually have lost that amount of money. Now, especially in a 401k or some kind of a retirement account, hopefully you've got many, many years before you're going to need that money. For some people, it's 5 years. For some people, it's 30 years. In the history of the stock market, going back over 100 years, the market always bounces back from every single bear market that we've ever had. For you to not believe that this market will bounce back, you really need to believe that something has fundamentally changed. America will never be the same. The economy that we have will never come back. And that hasn't been the case through the financial crisis, 9/11, the Cold War, World War I, World War II, even the Great Depression. It's always come back. And so I have absolutely no reason to believe that this time is somehow worse than any of those other things that we've seen in history. So I am as confident as I can possibly be about anything that we will bounce back. So for me, the worst thing you can do is try to lock in those losses and basically make what is a decrease in your statement value become an actual loss to your financial account. So the real question is, how long do you need to be patient? And unfortunately, while I can tell you with almost certainty that all that money will be made back and then some in the future, I can't tell you when that will be. So again, you want to be a long-term investor. You want to just have faith and confidence that we will bounce back from this as we always have. And you don't want to make any kind of emotional decisions. I mean, for some people, the best thing to do is not even open the statement. But, clearly all of us need to take a look. A lot of us are going to be unable to do that. The other point I would make is even if you're already in retirement, even if you're already living off of the income off of that portfolio, there's a reason why we have asset allocation. Part of that portfolio, if not a substantial part of that portfolio, especially if you're close to retirement, should be in bonds and not in stocks. And as I mentioned, stocks have gone down much, much, much more than bonds. And so even if you were to need to tap that account for income and take out small amounts of money, again, you don't want to lock in those losses across the whole account. There is the ability to raise cash and pay for distributions by selling the bond portion of your portfolio. That's exactly what you should do. When you're in a bear market and the stock market is really low, you only want to take out distributions from the bond portion of your portfolio. Once the stock market gets back to where it was before, it goes higher again through the process of rebalancing. You always want to make sure that you're replenishing that portion of your bond portfolio. By regularly rebalancing at least once a year, you're going to be forcing yourself to sell high and buy low because you're always going to be taking the portion of the account that has moved lower, which in this case is stocks. And whether you rebalance at the end of this year or the end of next year, you'll have that opportunity to move your account back to balance. And that's probably the most prudent way to go about thinking about your retirement accounts, both for people who have many, many years to come where you shouldn't touch anything, and even for those people who would need income in the short run and their account balances may not recover to their all-time high in the near term.
Hey, Chris, can you talk about some of the changes or shifts you're making in the portfolios that you manage?
Yep, absolutely. So, part of what I've been doing, and I was doing this last year as well, is as we go longer and longer to the end of a market cycle, you never know when the bull market's going to end. You never know when the next recession is going to come, but you do know that markets move in cycles as well as the economy moves in cycle. And as you get later and later cycle, basically meaning farther and farther along the bull market, we're progressing through the economic cycle that repeats over and over again. One of the most important things you can do is move up in quality. And so what that means is instead of just owning every single company that's out there, every single company in the S&P 500, you want to own those types of companies which have really good balance sheets, the kind of companies that have assets and cash and liquid assets that they can use to pay their ongoing obligations. The most important thing for a company as you go through a recession is the ability to make it to the other side. And so we had already been making changes in the portfolio to move to more quality companies, those ones that were less indebted, those ones that had a better cash position, those ones with better business models and more profitability, because every single company that gets through this recession, and I believe all of the companies that we own will emerge on the other side stronger, because there's the other more risky companies that are now going to have to struggle. It's those high flyers, those more, higher moving stocks that everyone was talking about last year. A lot of them are most in trouble this year. And so we've made sure as much as possible not to own any of those and to focus on the better companies. Now, as the market dropped as quickly as it did, Another thing you really have to be careful about is not making moves too quickly. If anything, you want to slow down the amount of moves that you're making when markets are dropping because they move so quickly. Markets drop down very quickly and then they bounce back really quickly, as we've seen over the last few days. So it's very important that as you're making changes in the middle of the turbulence, you actually want to slow down that pace. That's also something we've done. We've been making less changes as this has happened. But that being said, I was still making a change last Friday, and I had made a change a couple weeks before that. There's always an opportunity when things settle down to continue to move up in quality. And so for those types of investments that you think will continue to do well in any environment, when you go through a fire sale like the one that we've been through, more and more you start to see the baby get thrown out with the bathwater. So there often becomes times where you can move from companies that you think are very good and will make it through the recession to some of the best companies in America. As they all get sold off similar amounts, the best thing to do is to sell some of those companies which are very good and buy those companies which are outstanding. The companies that you owned a little bit of before, but they were too expensive for you to own more. This has been an opportunity to buy even more of the best companies in America. And so that's what we've been doing with the incremental changes in the portfolio. And that's something that we're looking at every day in terms of just seeing what's becoming available to us now as investors as a result of this sell-off that were not available at as good a price just a month ago.
Well, very good, Chris. I know you're extremely busy right now in this type of environment, and we've taken a lot of your time. We really appreciate you sharing it with us here today. The next time we reach out to you for one of these tapings, hopefully things will be a little more stable. That should be out in around June. Hopefully the U.S. is far down the road on its way to getting healthy again. But appreciate you and your insight into what's going on.
Well, thanks, Dan. Thanks so much for giving me the opportunity to speak to you and your clients. And I hope all of you are staying safe and healthy. And I'm looking forward to speaking with you again shortly.
Thanks so much. So that concludes this edition of Barnes Quarterly. We'd like to especially thank those that are in the healthcare professions and the first responders who we know are out there daily in the trenches helping us to get through this difficult time. We know that they've got families that they're away from while they're trying to take care of us, and we just especially appreciate the sacrifices that they're making at this time. In closing, I wanted to share with you a piece that was created by a gentleman by the name of Dan Sullivan, who's a business consultant that operates under the name Strategic Coach, who's based in Toronto, Canada, and consults with businesses all around the world. This piece is entitled The Scary Times Success Manual and was created back in 2001 after the events of 9/11. He's got 10 items which are suggestions for getting through difficult times such as we find ourselves in now. And I'm going to read right now item number 10. Forget about your complaints. Focus on your gratitude. When times get tough, everyone has to make a fundamental decision to complain or to be grateful. In an environment where negative sentiment is rampant, the consequences of this decision are much greater. Complaining only attracts negative thoughts in people. Gratitude, on the other hand, creates the opportunity for the best thinking, actions, and results to emerge. Focus on everything you're grateful for. Communicate this and open yourself each day to the best possible consequences. If you'd like a copy of the full text of this piece, please email me at sbarnes@barnescapgroup.com or visit our website, barnescapgroup.com.
There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including possible loss of principal. The economic forecast set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. Dollar cost averaging involves continuous investment in securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to continue purchasing through fluctuating price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any actions. All performance referencing is historical and no guarantee of future results. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.